Hey guys, this is David Stroud with Fairway Mortgage.
And I'm Kailey Hoskins with Equity Colorado Real Estate.
And today we're talking about some myths dealing with lenders and purchasing a home and how the whole finance thing works. And so, Kailey, could you maybe ask me a few questions? Do you have to answer those questions for you?
Yeah, okay. So there's a big myth out there with a lot of first-time home buyers that they need 20% down to buy their first home. And that can be daunting for, young people.
Yeah.
People in general.
Yeah. No, ideally, if you're purchasing a home, 20% down, at least that's ideal for many reasons. But if you're a first-time home buyer, meaning you've not purchased a home or owned a home or owned a mortgage in the last 2 years, then you qualify to put sometimes just 3% down if you qualify for a conventional loan. If you're going with an FHA loan, then you need to put 3.5% down for that. But then of course there's the VA loan where there's nothing that you have to put down. And there's a USDA loan, which would be for rural areas. And that would be, there's no down payment for that one as well. So we just to kind of find out what's the best fit.
Perfect. Another myth that I hear from first-time home buyers or people who aren't really sure they're interested in buying, but they want to know how much they can get in a home is there a difference between pre-approved and pre-qualified. So if you could tell us a little bit more about that.
Right. So being pre-qualified means simply someone's checked your credit, you've told them how much they make, or you told them how much you make, and they pre-qualify you to purchase a home because your credit works out based on what you've told them your income is. And in this market, that doesn't really work because those deals can easily fall through. Something could happen and maybe they misunderstood how much they got paid. So the difference between a pre-qualification and a pre-approval letter is that a pre-approval letter means that the lender has, of course, pulled your credit. They've looked at maybe what your W-2s are, your pay statements. They've looked at what your bank statements are to see that you have the money necessary or required to make the down payment to take care of closing costs. And so those pre-approval letters are much stronger.
Okay, that makes sense. And then another one is the 30-year fixed. If you could speak more on the differences between 30-year fixed, 15-year fixed, and who might be best to get those.
Absolutely. So the 30-year fixed rate mortgage is standard. It seems like today, most everyone gets a 30-year fixed. And one of the reasons they get a 30-year fixed is because their mortgage payment is less. So it allows for you to be able to get the bigger, nicer home and not have as high of a payment because if you got a 15-year mortgage, that means if you bought a $300,000 home and you have to pay that $300,000 home off in 30 years, then yeah, of course your payments are less each month. But if you had to cut that in half and it's 15 years, well then yeah, you're obviously going to be paying more each month to make sure that you can pay that all off within the 15 years. But the advantage of having a 15-year mortgage or a 20-year or a 25-year mortgage, or sometimes even a 10-year mortgage, is that your interest rate is going to be less. Now the sweet spot, if you think about baseball or tennis, or the sweet spot in this scenario would be if you could go with the 15-year mortgage because it makes the most sense typically because of the payment's not going to be so large that it's going to hurt you terribly, but also you have a better interest rate. Typically, if you're looking at a 20-year mortgage, it doesn't have as great of a decreased in interest rate as you do when you have the 15-year mortgage. And so that's why, if you can go with the 15-year mortgage, it can help you for sure. But again, not everyone has that ability, so they go with a 30-year mortgage. But even if you can, let's say you go with a 30-year mortgage and you pay an extra $100 toward principal only each month, in the long run, over that whole time, that time period, you're going to save not a few thousand, but tens of thousands of dollars on the bottom line. So tens of thousands of dollars you're going to save because you're going to be able to close your loan sooner. So that's what I always suggest to people. If you can, you go out to dinner every weekend, maybe don't go out every weekend. Cut back on one, use that money and put it toward your mortgage.
Perfect. Thank you for all that information.
Absolutely. If you guys have other questions or comments, please send us a message or watch some more videos.